welcome. Joining us for this session is Jay Mintzmyer, the founder and president of Value Investors Edge, an independent buy-side research platform. Now, Dr. Mintzmyer is the go-to expert for all shipping-related trading and investment topics. He's a frequent speaker at investment conferences, quoted regularly in trade journals, and hosts a popular podcast featuring shipping industry executives. To our live viewers, please share any questions you may have throughout this session in the live chat box. It is located on the right-hand side of your video player. Don't be shy. We will be leaving a few minutes at the end here for questions, time permitting. And with that all said, Jay, I will hand the mic on over to you. I'll be here if you need me, but the floor is all yours.
All right, excellent. Thank you for the great introduction. Welcome everybody to the Money Show event. I've had a long-term relationship with Money Show, been happy to participate in lots of conferences, virtual and in person. It's been almost a year though, so I'm excited to get back to this. Recently became a dad. We have twins that are coming up on 6 months, so life's been busy, but I'm glad to carve out a few minutes with you all this afternoon or this morning if you're on the West Coast like I am. So please forgive the kind of kitschy title there, 50% upside. I stand by that, but hopefully it drew some folks in that excited to see what we're going to talk about. Quick background on myself. If you're not familiar, I have about 15 years of experience in shipping markets. I started out on Seeking Alpha. We launched our independent research platform, Value Investors Edge, in May of 2015. So celebrated the 10-year anniversary this year. We're all getting older, hopefully wiser. But been involved for a long time in shipping. I have a master's in international policy and completed a PhD a few years ago on trade flows and sanctions. We'll talk a little bit more about the VIE performance. I want to highlight some of the amazing team we have over at VIE. We have a team of 12 total, including 4 interns. We have 6 full-time analysts. These are some of the more prolific faces and folks you might be familiar with there. Today, we're going to streamline things. We got 30 minutes, and I want to spend almost 10 minutes if we can on Q&A. So we'll try to streamline a lot of this, get this done. But this is today's focus. We're going to talk about shipping, why I think it's interesting. Repeat material for those of you who've seen this presentation before, but hopefully a good refresher. We'll talk about the VIE approach and performance. We'll do a little income stuff. I realize this is an income forum. I'm going to respect that. We're going to spend at least 5 minutes. I'm going to share a bonus income pick for y'all. And then we'll get into the meat and potatoes, talk about the top pick for 2026. Hopefully that gets us to about 20 to 23 minutes, and we'll save the rest for questions. So if you have any questions, please go ahead and throw them into the chat bar. So why invest in shipping? I hear that from a lot of folks of you can't make money here. It's too volatile. The managements can't be trusted, all these sorts of things. Some of those things are true. There's always a kernel of truth, right, when you hear something like that. But there's also massive outperformance in shipping, as you'll see as we go through today's slides. I like shipping personally because it's a niche sector. There's not a lot of broad market focus here, not a lot of experts, not a lot of folks that know what they're doing, and a lot of misnomers, trade opportunities that come up all the time. As I mentioned, the publicly available research, it's often limited, or it might just be outright wrong. A lot of times the gut instinct might be incorrect. For instance, after the Russian invasion of Ukraine, that was a very, very bullish catalyst for tankers and for energy shipping. But it maybe the market initially, or maybe a lot of folks initially thought war, oh, I don't want to touch that. We've seen some recent things with tariffs and sanctions where there's been beneficiaries to these actions, but the initial market gut reactions to sell everything. These are cyclical markets and they're leveraged to rates, so your timing matters. You have to be paying attention to what's going on. You have to understand when a market's primed for success or when things are getting bloated and sort of risky. News and trends, I think I kind of mentioned this already, but there's 3 to 6 months behind the curve. So hopefully what you're taking away from this is a sector where if you do the hard work and pay attention and work hard, you really can outperform. In terms of like a big name like Apple, I can't say I bring any edge to analyzing something like that. And just from like a gee whiz perspective, you know, I'm an academic in some parts of my life. This is the nexus, just the intersection between current events and geopolitics. If you like talking about war and sanctions and tariffs and trade and relations with other countries, shipping is the practical output of all of that, and closer and more so than any other investment sector you can find. And what everybody cares about, making money, right? And we'll talk about how we've done over the last decade plus. One other benefit to shipping is it's diversified within itself. And this is a little counterintuitive, but people think of shipping as a monolith. You know, how's shipping doing, Jay? shipping bad this year, shipping good this year. Look, there's 8+ segments of shipping. Each one's got their own supply demand drivers. Today, we're going to talk a little bit about the tankers. We're going to talk a little bit about the dry bulk. We don't have time to cover them all, but here's a list for y'all. Some of the learning curves in shipping can be a little bit steep, but it can be rewarding for those who take a little bit of time to learn. And it doesn't take years to learn, right? It takes a few weeks or getting hooked up with the knowledgeable sources, but you got to be careful about screening for classic value ratios. Things like price to earnings or price to book can be misleading, especially in a cyclical sector. You might say, oh, this is a low price to earnings stock. The earnings are surging. Earnings growth is great. Well, yeah, but the rates are about to go off a cliff. Or you might say, hey, this thing trades at a huge discount to book value, right? It's a value stock. But maybe they bought all those ships at the top of the market, so their accounting value is inflated. The real market value might be underwater. I've seen companies with a price to book ratio of 0.2 or 0.3x go bankrupt. So you be very careful with these classic value ratios. On the flip side, we're in a bull market like we are today. There's companies that have a book value of 1.4x. You might say, well, that's a little risky, a real asset company trading above book. Yeah, but the company was smart. They bought all their assets at record low values, and now the assets are worth more. So you can't really just look at these classic value ratios. Dividend yields can be misleading and dangerous. And I got a whole section on that coming up because this is an income form, but we'll expand more upon that one. But don't just trust a dividend yield. You got to do a little bit more deep diving than that. There's a big difference between the current rates and where we are in the cycle and the seasonality. For instance, dry bulk, the rates are almost always terrible around February. It's the Lunar New Year. China is resetting everything. The rates almost always slump. And that's when you'll usually see charts on broad, sites like Zero Hedge saying, oh, global trade's crashing. The BDI, Baltic Dry Index is in the tank, and that's every February. So that's normal. But you got to understand that seasonality and also where we are in the cycle. Are we mid-cycle, fifth inning? Are we recovery? It's going to be rough for a couple of years. Are we tip-toppy and things are risky, right? So you can't just look at the rates and say thumbs up, thumbs down. And I mentioned it already, the seasonality is important. And then corporate governance. You have to know these management teams, understand their incentives and alignments. I apologize if you hear some crying in the background. We got a babysitter with the twins, but anyways, sorry, folks. Corporate governance is very important in this sector. It's important to know who you work with, and that's why being in the sector for more than 10 years, I've met almost every single management team personally. We've done a lot of podcasts with them, like they mentioned in the introduction, and that's important. You got to understand where those incentives are aligned or misaligned. How do we outperform? Well, we do all those things. We've done all the hard work. We have a team of 12, right? So a lot of folks doing hard work, doing the right things, and we stay in our lane. Absolutely. I'm not going to just read this whole list, but you can see that every person has a role and has a job, and they don't venture outside of that role. None of us are going to be talking about Bitcoin or Apple or Tesla or none of that stuff. We are here only for shipping and related energy infrastructure. Because of all that, I believe the proof is in the pudding. You can see our long-term results from 2016 to 2018. Those are tracked trades. In 2019, we launched long-only model portfolios. We wanted something easier to follow for our members, something we can have on like a Google sheet that's just good through posterity, through time. And you can see the performance. 38.7% annualized return over the last decade. That's a 25x return. That compares to the S&P 500 at 14 and Russell at 8 and the shipping industry at 11. I get that question a lot. People say, hey, Jay, I love what you do. You do great stuff. Shipping's great. Is there a shipping ETF? Yeah, there is. The symbol is BOAT, B-O-A-T. So feel free to look it up. Take a look at their 5-year returns at BOAT, and then take a look at Value Investor's Edge 5-year returns. Shipping industry by itself, you're not going to be able to take advantage of the cycles moving, cycles changing, getting ahead of things and that sort of stuff. And that's where we outperform over time. So yes, shipping, we love it. It's been great for us, but it's not just a passive. We buy a lot of shipping stocks and we sit on them. There's definitely some activism involved. So with that, theme of the day, income opportunities in shipping. We'll spend a couple minutes here just so I can say we did. But the pitfalls of shipping income, I want to just warn people about the traps. Shipping, I shouldn't be saying this, but I got to be straightforward. It's not the most easygoing sector for income. If you're coming here for income, there are some good vehicles and we can find them, but it's not as easy as looking at a dividend yield. There's a lot of traps. Those dividend yields are often based on free cash flow and they're variable payouts. So when times are great, there's this giant dividend, but it's not fixed It's not sustainable. The second rates go over, the dividends cut. Sometimes it's zero. So be very careful with those dividend yields. There's a lot of times where a firm will have old legacy vessels that had these good deal charters on them. They fixed them for 5 or 10 years. Good job on the management team, right? 5 or 10 years ago. But those charters are about to expire and the ship's basically worthless because it's really old or the market's bad. And when that charter expires, suddenly that dividend coverage goes right out the window. So you got to be careful of those. There's been a lot of those. You got to watch for leverage and refinancing. A lot of these firms will run leverage up real high, pay out a big dividend, and try to lure in retail investors. Well, that works for a couple of years, and then you got to refinance. And that's not just shipping. I mean, that happened with MLPs and pipelines. A similar story, right? Um, I mentioned this at the start. Is that dividend variable? Is it fixed? Is it backed by anything? Is there a 5 or 10 year contract, or is it just spot rates? If it's spot rates, be very careful. Is this management team, do they have a track record? Are they trustworthy? We've seen cases where there'll be big dividends for a couple quarters, and then boom, there's a share price offering or a secondary or something like that. So again, I'm the shipping guy, but I'm warning people to be very careful about income in shipping. That said, we're the experts in the sector, right? We've had a shipping income model since 2019. And over the last 7 years, we have only had one surprise dividend cut in 7 years. I am very proud of that fact because there's a minefield out there, folks. And this is how we've done it with income over the last 7 years. It's not as eye-popping as the other chart because these are more conservative, more easygoing positions. But you can see the average yield each year. We generally have between 8 and 11% yield over the year. This year's a little bit lower. We've been more conservative in 2025. But you can see the annualized return, and you can compare that to the S&P, way above the Russell, or the AMLP, which is our high yield comp. So this is really kind of the comparable. Our yield has been about 1.5 times that of the AMLP, and we have more than doubled the total performance. So that's historics, but I want to share an income idea today. I like SFL Corp, stock symbol SFL. It's got a 9.7% yield. It has been beaten down for good reason. They had an oil rig that failed to find additional employment. The offshore oil rig market's been very difficult, but they responded to that. They're trying to fix it out. It's probably going to take another year or so. They've already cut the dividend in August. I think there's a low chance of another near-term cut. I've known this management team over there for almost a decade now, and these are very smart, capable folks. They're straight shooters. If they have to cut it eventually, right, they will. They'll do the right thing. But I think for at least the next few quarters, that the dividend's stable. The company's net asset value range is between 10 and 12, depending on what sort of multiple and residual values you put on things. So 10 more conservative, 12 a little bit more optimistic, but that's without the Hercules rig. That's if that thing goes to zero, never makes another penny. It's worth 10 to 12, and SFL's trading in the eights. So you got upside to 10 to 12 just on that 9.7% yield for income and sort of a value play. So we eat our own cooking. This one is in our income model. In fact, it's a little bit more heavily weighted in the income model. It's got a 9.7% yield. It trades below its net asset value. It's got a great management team, great track record. And here's sort of the bullish kicker. I'm not promising anything, right? This is more speculative. But if that rig is fixed by the end of next year or into 2027, we believe there's upside the 12 to 15 range. If you pull up SFL and do like a 5-year chart, you'll see it traded there before. Everything about the company is the same except for the difficulties with the Hercules rig. So that's kind of the case, and hopefully that's a good income pick for folks. It's got some good income, it's got some good upside, and it passes those concerns that we shared in the previous slides. Now let's get into it. Why shipping into 2026 and our top public pick? So there's 4 reasons that I like shipping into 2026. There will be a more expanded public article coming out on Seeking Alpha, hopefully later today, but if not later today, again, for folks watching the recording, this is November 19th, about 1 o'clock in the afternoon Eastern time. Hopefully it'll be out later today. If not today, probably tomorrow. It'll expand upon this in more detail, but the high points here. I believe the tariff headwinds that we've been dealing with for the entire past year, ever since the election of President Trump and Liberation Day and thus forth, they're shifting, in my opinion, from consistent headwinds into what I believe will be rapid tailwinds. Now, I'm not making a prediction on what the Supreme Court will do. I think they've given their own hints on what's most likely, but even without the Supreme Court, we have seen some excellent deals for shipping. And it's counterintuitive because everyone thinks shipping is going to get hurt the worst by this sort of brooding trade war between US and China. I actually think shipping, particularly energy shipping, could be a key beneficiary. President Trump has signed enormous energy partnership deals with Japan, with Korea, and with the European Union, all of which are based on investing in US energy and US export capacity to ship that energy back to Asia and Europe, respectively. That is very good for the future demand for tankers, for LNG carriers, for LPGs, maybe for ammonia or CO2 if we get into that. I don't think we will in the current administration, but these are long-tailed, very bullish tailwinds that the market has not been appreciating. Whether or not the tariffs get rescinded, we've also seen a big one-year truce pause framework with US and China. So I think we're really starting to turn the corner here. And I think the broad market is lagging. It's still not appreciating that shipping could be actually a winner here. It's counterintuitive. It could actually be a winner. Tanker spot rates are surging. They're phenomenal right now. In fact, I'll show in a couple more slides exactly where those spot rates are. This market appears to have legs. And if you've been on a previous money show, you've probably heard me talk about the tanker market. You've probably seen my supply slides. I've been talking about this for about 2 to 3 years. It looks like, that's like the prophet that was finally got it right. But it seems like we're finally here and the legs are finally running. So we're excited about that. Dry bulk is another segment of the market. We're talking energy here. We're talking tankers. We're talking dry bulk. I believe it's poised for a multi-year bull run. I'll explain one of the key catalysts forthcoming. And finally, this might be the most contentious, and I like to stay in my lane, and this is getting a little bit outside, but I think there's potential for a big market rotation away from tech, the Mag 7, the AI stuff, back into value, similar to what we had in 2022, where we might see a broad market pause or slowdown or even a big pull back, but we might actually see bullish outcomes for real classic value assets, cash flow generators, things like shipping. And if that happens, that's fuel on the fire to the top 3 catalysts here. The first one, big shift in tariffs. 2 and 3 are big term rates and free cash flow. And that fourth one is just an overall macro factor. And that's the most contentious. I understand that, but I think those are interesting. With that, you've waited this long. Our top public pick for 2026, it's got a lot of tanker exposure. It has massive dry bulk upside in 26 and 2027. That is CMBT Tech. CMBT is the symbol. We believe there's 50% upside potential by mid-2026. The bullish case, I believe, is for a share price north of 20, which would be over 100% upside in the next year. So let's get into it. Why do we like CMBT? Which, by the way, trades around $10 a share as we're talking. So first of all, let's talk about tankers. If you've been on one of my webinars in the last couple of years, you've seen a similar chart to this. We love the excellent tanker supply set up through 2027. If you look here, 23, 24, 25 were phenomenal years. We've been banging the table saying things are set up, folks. It is a coiled spring. And here we are. Rates are surging, and we have very few deliveries in 25. And you look at 26, and there's a few more deliveries. But when you look out historically, it's kind of an average year. And you got this trough to make up for. So we're not particularly concerned in any sort of way until maybe 27, but I'll show you why even that doesn't really concern us. So the current tanker order book, that's all the stuff in the red, that's all the new ships, are about 13% rounding up. Just remember 13% in your head. And I'll explain why we don't really worry about 26, 27, and 28 supply. Let's look at the old, decrepit ships on the water, only, in my opinion, supported by the dark fleet factors. The Russian sanctions, the Iran sanctions, Venezuela, North Korea, all these bad actors are using these old tankers to avoid sanctions. These ships will not pass muster in a full-fledged commercial market. Look at this, 22.5% age 20 years of older. Most commercial tier 1 customers, think Chevron, Exxon, Shell, will not touch anything above 15. Now you can go over to Asia and trade among teapot refineries and things, and they'll probably take your tanker up to 20, maybe 21 years old. But you get past that, and you could only deal in dark fleets. These are decrepit, scary ships that question, in my opinion, shouldn't even be on the water. And we got 22% of those right now versus 13% forward supply. So the forward supply growth, in my opinion, holistically is still negative. It's still negative by about 9%. So very bullish supply picture. Now check this out. This brackets the fleet from 2012 and older. And why does that matter? That means that by 2027, a year and a half from now, not even a year and change from now, 52% of the entire fleet, including the new builds. By the way, if you order a new build, you're not getting it until 28 or 29, probably 29 at this point. In fact, there was recent orders for 2029 deliveries. So 27 is already fixed in stone. You're not adding more ships there. Let's keep that clear. So 52% of the entire fleet on the world's water is non-competitive by 2027. What was the order book again? 13%. So phenomenal setup in tankers. And I can't promise the rates will keep going forever, but the supply side is very accommodating. Here's the tanker rates and how they're doing. The first chart is from Value Investors Edge. It shows the quarterly expectations so far. This is updated weekly. Each week when you update it, that number goes larger and larger. So here's the VLCCs, and this is sort of a heat map. This is last year, how to do last year. This is from last quarter. This is the average Q4 over 20 years, and this is the average 10 years, right? So you get all sorts of heat maps, and they're screaming green, right? And the latest spot rates, which we update every Sunday, are below. You'll see VLCCs at 120, and normal rates like 30,000, by the way. Suezmax is 88, normal rate 25 to 30. Aframax's normal rate's 20, they're at 65. And then this is just so you can see the percentages. I mean, it's off the charts. 400% year over year, 130% up, 110% up. I mean, it's incredible. Well, CMBT, the company we like, has a $3 billion tanker fleet, and they are poised to benefit. They have a tanker fleet almost as big as any other public player. There's only like one or two other tanker companies that have a bigger fleet. So this is an excellent place to get exposure to tankers. Now let's pivot. So we talked about tankers, hopefully got all bowled up, got excited about that. Let's talk about dry bulk. So the big catalyst in the dry bulk market, which by the way is humming along nicely without this catalyst just started last week. It's a Simandou iron ore mine in Guinea. It is a China-backed strategic project. It is based on national security, if anything, for China. They rely intensively on Australia and more recently Brazil for all their iron ore. Iron ore is a key to everything, for infrastructure, for manufacturing, for military equipment, for everything. So to make steel, right? So this is very important. And they need to diversify away from Australia is borderline hostile to China, and Brazil is obviously pretty close at times, right? Maybe not the current administration, but they're a lot more close to the US than they are with China. And that's been clear. So they need to pivot. So they've been working on this mine for almost a decade. Production began last week. Very exciting. Very good time to be here talking about this. It's going to ramp through 2030. The full capacity is 120 million tons a year, and that is 10% of China's demand. So people say, well, what if China weakens, Jay? What if China doesn't grow at all? Well, I don't need it to grow at all. I just need that 10% baseline that we're going to take away from Australia. And it will replace Australia. China's paid for this thing. China's underwritten this thing. China and Australia are not exactly best buds. So the obvious play here is that all that new iron ore is going to go from Guinea to China. And if China keeps growing, oh, sure, they'll keep Australia coming too. But if China pauses or flatlines, it's just going to be Guinea replacing Australia. So just a geography lesson for y'all, and in which shipping is important is the distance. Here's China, roughly, right? Forgive my basic blocks. Here is Headland, a main iron ore export port for Australia. Pretty damn close, right? Here's Guinea. Whoa, yeah, Western Africa. Beautiful. Yeah, forgive my cheap lines there. We're talking about triple, more than triple, the ton-mile distance. That means for every cargo that replaces Australian with Guinea, with Simandou, is going to require triple the dry bulk assets. So we can run the math, but it comes out to about 600 additional cargoes per year in the next few years. So very, very exciting times. 600 additional cargoes, over 200 additional ships needed urgently. Meanwhile, we got this demand that's picking up. We don't have any new supply. If you look at 25, we have 1.5% capacity growth. If you look at 26, we have 2.2% capacity growth. This is not including scrapping. It's just new ships only. And you can see this compares to bubble years, 8 or 9% every year, and then 20%. So supply is not coming forward. Here's a very similar chart. You saw it with the tankers. And you see this little bracket of ships over here. 45% of the fleet will be obsolete by 2032. And I say 2032 because bulkers can run a little bit older. So it's not quite as crazy as the tankers, but 45% of the fleet will be obsolete by 2032. And if you look at the order book, we have an order book that's around 8%. And so that order book needs to be a lot bigger. And again, we're starting to take orders here. You can see at the end of the chart for 2029. CMBT, the company, why do we love it? It is 30% tankers and 60% dry bulk. So you're getting 30% that's riding the current rates, making a ton of money, And you got 60% that we believe is positioned perfectly for next year in 26 and then in 2027. You got the oil tankers down here. You got 30 on the water. You get 7 new builds, so 37 tankers worth about 3 billion, rounding up a little bit there. And then dry bulk. You got 17 ships from CMBT, brand new, perfect vessels. You got 89 that they just merged in from Golden Ocean, and you got 13 more that are on the water. And you got just over 6 billion in fleet value there. So CMBT trades at a 30% discount right now to what we estimate is an end of year, so 2025 E, which is, guys, it's 6 weeks away, so not that far. We believe NAV's around 15 by the end of 2025 based on current assets and free cash flow. It trades around $10 right now. And why is that? There's two key reasons, in my opinion. Number one, I think it's hated and misunderstood as an ESG play. And the company does not do themselves any favors. If you pull up a presentation, the first slide says all this stuff about decarbonization. And guys, like, read the room. This is not the hot theme. That was a great slide deck 2-3 years ago, right? Nobody wants to hear about decarbonization anymore. I mean, I don't, being facetious, like, obviously people still care about it, but investors are tired of it. They're cynical. They're realism now. They just want to see cold, hard assets, right? But the reality is that that's all just marketing, gimmickry. 90% of this company is tankers and bulkers, classic shipping. So people hate this thing because they think it's an ESG company. It's not. It's a shipping company with the overly clever marketing slides. The current market cap is less than $3 billion. They have 11 billion in assets. I love that leverage when I'm bullish. Let's just do some quick napkin math here. Tankers are worth $3 billion. In a 20% upside scenario, which I think is fairly conservative, you get 600 million upside in assets. That's $2 a share. Yeah, okay, $2. That's all right. Bulkers, there were 6 billion. Here's where things get exciting. 30% upside scenario in the next year and a half. I think that's actually fairly conservative as well, if you're bullish, right? It's obviously bullish leaning. That's $6 a share. So now we're up $8 a share. And then CMBT trading near its peers at 100% NAV, which it did in the past when it was known as Euro NAV. That name might ring a few bells. Euro NAV was before the rebranding of CMBT. So you got $5 just to trade to peers, and you got $6 to $8 if the markets are decent and promising in 2026. So that underwrites our 6-month target. We believe it's worth 15 plus in the next 6 months. That's 50% upside roughly from today. And 1-year bull target is well north of 20. That's bullish, right? That requires dry bulk to do well. I need to put some caveats and asterisks on that one. That requires things to go correct. So if dry bulk rates are terrible next year, we're not going to be talking about 15 to 20. But if dry bulk rates do well in 2026 into 2027, then I believe we could see 20 plus in a year from now. Hold me to it. I'm very publicly available on Twitter and all these places. So hold me to it, guys. All right. I said we'd leave some time for questions. Looks like we got 3 to 5 minutes, but let's have it.
Fantastic. Thank you, Jay. No, I did get a lot of questions earlier in the session about this CMBT. So if I'm ask you something that you've already covered, we'll just move along. But the first question I had from Samu a while back here was joint question. Why is Star Bulk not so interesting anymore? And what are the main risks for CMBT if it's got, since I understand it has more leverage in bulk than Star Bulk?
Yeah, no, excellent question. There's about 3 reasons why I like it a little bit better than Star Bulk. And I mean nothing negative about Star Bulk. I've known that management team basically my whole career. Great respect for what they do. It was one of our model picks a year ago. So we stand by them for sure. Number one, I like a little bit more leverage when I'm bullish. If I'm bullish on a market and I expect the assets to go up, I want the assistance of leverage, kind of like when you buy a house, when you buy a commercial property. You don't just go out there and buy it with cash, right? You use a loan and you get better returns. So I think the leverage is a positive in this scenario. I don't think it's overdone. It's about 60% against brand new modern assets. That needs to come down to 40 to 50% over the next couple of years. But I think the leverage is actually a positive, number one. Number two, they traded a bigger discount than Star Bulk does. So just on discount alone, it's about 20 to 30% cheaper. So that's a positive in addition to the upside leverage. So the upside leverage, bigger discount. And reason number 3 is they have 30% of the companies in tankers, which is raking in free cash flow right now. Star Bulk is doing okay, but you just saw their earnings come out yesterday. We haven't turned the corner on dry bulk. Dry bulk's okay, but we're not super bullish yet. And so we need something to bridge us there. And that's what the 30% of tankers is doing. So those are the 3 reasons why I think CMBT is a much better pick at this point than Star Bulk.
Thanks, Jay. I also had a couple of people asking here what the effect of the Ukraine war resolution on tanker rates will be.
Yeah, that's an excellent question. I think folks have looked at that overhang for a long time. It's no secret that the Ukrainian war was very bullish for product tankers in particular. It wasn't really bullish for the VLCCs, the large tankers. And the large tankers are the rates that are doing really well now. So I don't think that's anywhere near related now to the Ukraine war as much as it used to be. I do think there's a little bit of overhang in product tankers. However, if there's a little bit of pullback in rates, I think that's going to be felt almost entirely on the old fleet. And see if I can go back real quick. I know we're running low on time, but if I go back here, it's several slides, but it's that tanker one where it shows the age of things. I need like a quick hotkey here. Yes. So 52% of this fleet, these dark purple vessels are basically entirely dark fleet. And so if those sanctions go away, there's no reason for those ships to exist. If you look at these like purple ships, maroon or whatever color it is, versus the new build order book, I'm very bullish overall because global demand is not going to go down, and we're going to see a reduction in the dark fleet and more things trading on the good complicit fleet.
Fantastic. I know we are short on time, but I did have one more interesting question here. This was from Theodore. He said, "I'm surprised that there's no mention about India, which currently has one of the most aggressive ship construction programs in the world, albeit mostly military vessels. How does India rank?"
Well, India is very interesting on the demand side for petrochemicals. So LPG in particular, liquefied propane, they're a huge demand driver for that market, and they have been backstopping amazing results for many of our shipping firms. India does have some commercial shipbuilding, but as the person mentioned, it doesn't really compare very high to Korea and China. China's number one by far. Korea is number two. And so India is more interesting as a demand driver. So I think their bullish demand on the LPG, I expect that to continue. We're going to probably see some more LNG as India looks to try to depollute some of their cities and some of their power production. But I see them much more on the demand side, if that makes sense.
Well, Jay, thank you so much. It's been a fantastic session here, and so glad that we could take some time for a Q&A with the audience. Pleasure having you on.
Always, absolutely.
All right. And to those of you watching live, thank you for joining us. And be sure to stay tuned as we have more in store for you today in this Money Show Virtual Expo. I hope everyone has a wonderful rest of your day. Take care.